You can make a lot of money earning income through your investments. But if you're smart and you're thinking generational wealth and legacy, then you know that the death benefit on a life insurance policy is going to be 10 times greater than any of the income that you can actually earn. And the beautiful thing about the death benefit is that it's tax free to the next generation. I find it very interesting how agents that are selling IUL products or financial advisors that are making commissions off of investing their clients' money in the stock market love to bash whole life insurance as if it's the worst product ever created. They want to tell everyone to buy term insurance and invest the rest in the market. And their logic is that in your early years, when you have a family and they're living with you, that's when you need to have life insurance. I completely disagree with that approach. The beauty about life insurance is that there's a death benefit that gets left behind, and that death benefit is generational wealth. It doesn't matter how much income you earn, how many stocks you buy, how many properties you buy. It's highly unlikely that you can out earn the amount of death benefit that you can purchase. In your lifetime, yes, you can make a lot of money earning income through your investments. But if you're smart and you're thinking generational wealth and legacy, then you know that the death benefit on a life insurance policy is going to be 10 times greater than any of the income that you can actually earn. And the beautiful thing about the death benefit is that it's tax free to the next generation. So, you can't beat that, bottom line. Now, the problem with term life insurance is that most people outlive their term policies. The insurance carriers know that, these agents know that, and these financial advisors know that. So why are they telling you that buying term insurance is all you need when chances are you're going to outlive that insurance? And the reason why is the same argument that they're making about whole life people making commissions. Well, that's why they're making their argument. Guess what? They're making commissions. And I have no problem with that. I have no problem with people making commissions. But why do you bash other professionals' ability to make income and then act as if you're not making income through commissions and as if your product or solution is the only product or solution? How about a proper blend? How about a diverse portfolio, right? So this argument about buying term insurance and investing the rest and basically ending up outliving that term insurance and not having a death benefit to leave as a legacy to the next generation, that's just ridiculous. That makes no sense to me, especially when you can probably create a combination of both. And I'll elaborate on that in 1 minute. So financial advisors, they want you to buy term insurance and invest the rest because they want you to put all your money in their hands so that they can invest it in the market and they can make all the commission. Think it through. On the other hand, you have other life insurance agents that all they want to sell is indexed universal life insurance. And their argument there is that you still get to participate in the market indirectly through the life insurance policy, but there's a bottom protection, so you'll never lose any money, and there's a cap at the top, so that cap is what protects the bottom. The problem with these illustrations or with these policies and their illustrations is that they never deliver as illustrated. I just spoke to someone yesterday, said they saw an illustration at 12.5% on the cap rate, and now the cap rate 3 years in is at 6%. And so they're not even making 3% interest on that policy growth. It just doesn't make sense. And so you're buying a product that transfers all of the risk from the insurance company over to you as a consumer because now your money's being invested. The agent that's selling it to you doesn't know how to manage buy and sell shares. They're not experts there. They're just selling life insurance. Most agents, I have to say, they're just going to sell you a policy and set and forget it. They're off to the next client. The problem is life insurance, as any insurance, never was intended and has never been designed to be an investment product. Insurance is a protection product. It protects you if something happens. That's why you buy car insurance. If you get in a car accident, your car insurance protects you. You have health insurance so that if you get sick, your health insurance protects you. Life insurance is supposed to protect you so that if you die, the death benefit protects your family. With whole life insurance, it lasts your whole life. So that means that you don't have to worry about outliving the policy. Now, the argument's going to be, well, it's so expensive to buy whole life insurance to get an equal amount of death benefit. And I'm not going to argue that 100%. If you compare apples to apples and you're buying pure death benefit with a whole life policy and you're putting 100% of your premium towards the death benefit compared to a term policy, well, of course, the term policy is going to be much less expensive. And that's because it's less risk on the insurance carrier, because the maximum amount of term you can buy is 30 years. And if you outlive that, the insurance company profits 100%. In a whole life policy, all of the risk is on the insurance company because it lasts all the way to the end of your life. And so you can't lose that insurance. The only way you'd lose that insurance is if you stop paying your premium or if you breached your contract in some way, shape, or form. Now, what a wise way to approach it would be is to have a little bit of both, a mixture. And this is how I would recommend it. You purchase a whole life policy so that you can store your money in the policy as an alternative savings account. We can design the policy where 10%, 20%, 30% of your premium is going to pay for the insurance. So that means that 90, 80, or 70% of the premium is going to go into the cash bucket. These agents that are selling these IULs are not telling you about this. These financial advisors either don't know this or they're just not telling you this because they want you to hire them to put all your money in the market. So if you can store your money in an account that is clean whole life insurance, your money is not being invested in the market. It's a protection for your money. It's a protection for your death benefit. And on top of that, these policies have living benefits so that if you become chronically ill or terminally ill, or you meet certain medical conditions, you can receive an advance from the death benefit while you're living, which you don't have to pay back to the policy, and that's tax-free. That's right, an advance from the death benefit while you're living under certain medical circumstances. That's living insurance. Whole life insurance, when designed properly, it is the fundamental foundation that you should have for your financial plan. Because if you store your money in this account, you can access it, just like equity in a real estate asset. You can access the equity in your policy. If you're putting $100,000 into a policy and you structure it where 10, 20, or 30% pays for the premium, so 90 or 80 or 70% goes to that cash bucket, that 90, 80, or 70% is accessible in 30 days, immediately, as soon as you set up the policy. You don't have to wait 5, 10, 15 years to access your liquid capital. So now I can go take a policy loan against that equity, and I can then invest in the stock market, invest in real estate assets, invest in whatever I want to. And guess what? I've created a hedge against losses because all of that is protected by my death benefit. If I took money from my savings account and I invested it into the stock market or into an asset of any kind with the hopes of getting a return on investment, and I fail in that investment, investment crashes and burns, that's a 100% loss for me. If I funnel that money into a properly designed whole life insurance policy with a major mutual company, and I borrow against that policy and then invest that money, then guess what? The death benefit is protecting the money that I've borrowed against my policy, which means, yes, I have a policy loan that I pay back eventually. The insurance company does not tell me when or how much or when or how to pay that policy loan back. It's up to me. I can pay it back aggressively. I can pay it back slowly over time. It's entirely up to me. One thing I always recommend and I strongly urge is, if you borrow against your policy, is that you always pay the interest so it doesn't compound against you. And I also recommend conservative borrowing. Just like if you were borrowing from a home equity line of credit or a credit card, you don't want to max out your credit line. So treat your policy loan and the cash value in the policy just like you would a line of credit from a bank or a lender or a credit card. Don't max it out. I recommend keeping it at 60 to 80% max. The insurance carrier will allow you to borrow up to 90%. So if I put in $100,000 and I borrow $90,000 and I invest that in the market, and that investment crashes and burns in the market, it's protected by my death benefit. I can pay that $90,000 back slowly over time. And if I die before I pay back that full loan amount, then the death benefit pays for that balance of the loan. It comes out of my death benefit. Assuming on a $100,000 cash value, let's say I had a $2 million death benefit. So let's say on my death, I have a $20,000 balance I didn't pay back, or a $50,000 balance. They're just going to take that out of the death benefit. The generational wealth, the legacy that I leave behind, is still going to be significant. 1.9 million. Come on, think this through. What they want you to think about is the short-term gain of investing. What I'm trying to help you to see here is the long-term play of generational wealth, but still having the ability to leverage and access that money so you can invest it for that short-term gain. So I'm not saying not to put your money in the market. I'm not saying not to buy real estate assets. 100%. However, if you put your money directly into these assets and you lose, you lose. By protecting it in an insurance policy that's properly designed, then yes, you lose, but you're protected. So in the big scheme of things, you're still leaving a multi-million-dollar death benefit. So guess what? You didn't lose. It's a win, even though you lost in that investment. Perspective. That's all it is. A properly designed whole life insurance policy is not to be used for an investment. The point is not to put your money in there and let it sit there as an investment where you're expecting that to create wealth. No. You're talking about 3 to 4% guaranteed compound interest growth with dividends between 5 to 6% annually. This is good for a savings account. However, if you can get a savings account like that with a bank, then that money is taxable. Inside of the life insurance policy with a properly designed whole life major mutual company, that money is going to grow tax-free. Tax-free growth. When you borrow against it and you pay back, it's tax-free. There's a way for you to offset that interest if you have a business, simply by making a loan to your business and using an intermediary like Pigeon Loans to draft up a legal binding agreement so you have a loan from your person to your business, and have your business pay yourself back and pay the interest to you and write off the interest on the business debt. So you can even offset the interest rates if you're strategic. Set up a trust and have the trust own the policy and make the beneficiary the trust. And in the trust, create laws and rules that delegate exactly how your wealth is going to be distributed to your children or your next of kin, so that you can, in your will and testament, through your trust, have your will immediately executed without probate. And you can literally say in that trust, in that will, that you want a portion of or all of that death benefit to repurchase new life insurance for your next of kin or for your children or your children's children even. This is going to multiply, where you're going to be able to then multiply that 10 million that you qualified for to 100 million for your children, to 300 million. Who knows where you can go with the death benefit as legacy to your children and your children's children if you teach your children this strategy. Some people call this infinite banking. Some people call this becoming your own bank. I don't call it that. Call it whatever you want. It's very simple. It's whole life insurance that's properly designed so you have the maximum cash value to be able to save your money. It's secure, it's safe, it's protected. In most states, it's protected from any credit litigation. Creditors cannot come and get your money inside the policy in most states. So your money is safe, it's secure, it's growing compounding interest, tax-free growth, and you have access to that money to invest and do what you want to do. So when you hear somebody say, don't buy whole life, and they're telling you that it's too expensive to buy whole life, that's because they're banking on you looking and comparing at the cost of pure death benefit on a whole life policy compared to pure death benefit on a term life policy. Now, if your objective is to get the maximum death benefit, then what you should do is set up a whole life policy for your banking functionality so that you have the savings component based on what you can commit to for yourself for savings. Use this as your saving strategy. And this works as an emergency fund, and this works as an opportunity fund, as well as a retirement fund, and ultimately your legacy. But that's not going to buy you the maximum death benefit, because you're right. If you're buying it for the purpose of death benefit only and not for the saving strategy, then it is extremely expensive strictly for the death benefit. Now, in that whole life policy, you can put a 10, 20, or 30-year term rider on that policy, which is very inexpensive to add much more death benefit into the policy. So that's one way to buy more death benefit inside of a whole life policy, is with a term rider. But if you still want to have more death benefit and you don't want to pay the premiums on a whole life policy, then you secure your whole life policy for your saving strategy so you can save and store your cash and let that grow and have access to it. And then you buy a convertible term policy. Notice I said a convertible term policy, not just any term, but a convertible term. What that means is at some point in time, you can convert that term into a whole life policy. Why? Because you secure the term rates for the death benefit, but when it comes time for that term to expire, you have the option and the opportunity to convert it into a whole life so you don't lose 10, 20, 30 years of premium. There are also return on premium term policies, but I believe a convertible term is wiser because then you can, like I said, convert it to a whole life. But this is going to give you the ability to cover your human life value, to purchase the maximum death benefit for the minimum premium on the term policy. So I would set up a convertible term policy for the maximum death benefit and set up your whole life policy for your saving strategy where you can store your cash value. And the goal there is to minimize the death benefit, but still buying enough death benefit to store and save as much cash as possible. And if you want to put more death benefit into the whole life, then use a term rider. So for those people, again, that are just telling you whole life is too expensive, and that whole life is just not a good idea, either they're just uninformed, they're ignorant, they don't know how to design these policies and how to properly structure them and use them, or they're thinking about them as an investment versus as a saving strategy, which is where you create an emergency fund and an opportunity fund to borrow from so that you can invest. I'm not saying not to invest. I'm saying to protect your investment by starting here first. Make this the foundation of your financial strategy. And from here, borrow and invest. And in the end, you'll leave a death benefit that's going to be 10 times what you may have earned in your real life. Think it through. If you want to see a properly designed whole life insurance policy and what that would look like for you based on your age and what your savings capacity is, if you'd like to look and see what a convertible term would look like for you, if you'd like to see this illustrated and designed properly with a major mutual company, please take advantage of a free consultation. We'll connect on a Zoom session for 30 to 45 minutes. I'll show you these illustrations. I'll create them for you. When you book the call, it'll ask you the basic questions that I need answered to design the illustration. No obligation or commitment. And if what you see doesn't make sense, no pressure. You say, thank you, Sebastian. It was a pleasure. And that's great. That's okay. But I'm 100% confident that when you see a properly designed policy and you realize that this is not a risk, but this is a secure place to protect your money, this is a place where you can have confidence on your future plans, where you have guarantees from the insurance carrier, where your money is not being invested in the market, where your money is safe and secure, where the insurance company takes all of the risk, then take advantage of my offer. If this video was of value to you, please make sure you like, subscribe, and share. Thank you for watching. It's the Approved Guy signing out. God bless you. Take great care.